All right. Hello, Kent. How are you?
Great, Sunshine. How are you?
Good, good. Excited to start our second meeting. Just to give a summary of last week, at our first meeting, we reviewed proof of work versus proof of stake. And then we looked at the types of proof of stake, solo, SAS, and then the pools. And then we then focused on Rocket Pool. And then we did a brief overview of the tokenomics of Rocket Pool and then the RPL and RETH token. My understanding now is the RPL token is for the node validators. The RPL is more collateral for the node validators for penalties. And then the stake ETH or the RETH is for the stake validators as collateral. So that was clarified. And I think today we were going to talk about discussing more of the tokenomics and then the actual rewards.
Yeah, that we covered a lot the last time.
We did. And Rocket Pool has a really good site. They have that explainer series that's really good, but I think this is good to go over, and hopefully this can be more of like an expansion pack from that to, maybe have different learner sessions or ideas of learning that other people can kind of comprehend as well.
Yeah, I love it. Everybody learns differently, and that's why we're recording our mentoring experience of, ramping you up from understanding crypto, but then focusing on Ethereum and the infrastructure behind Ethereum, and then picking, one of the best projects out there. We can't say it's the best. There's many alternatives, not many alternatives that are great, but there are other alternatives, and we plan to cover that later. But it's always, I've found simplest just to guide and start in one place. And I have experience with Rocket Pool, so that's why I wanted to dive there with you. I have a clarifying piece on the summary that you said. It was beautiful and covered a lot of different topics. Uh, Rocket Pool's tokenomics is a deep dive in itself, but you had it right that RPL is the collateral for node operators, and that RETH, the stake ETH, the liquid staking token, is then given to the smaller investors that they can hold in their wallet. So when you're a validator, you do not get the RETH in your wallet address. So I lock up my Ethereum along with RPL to then create that liquid staking token RETH on the public market for smaller investors. Yeah, perfect.
Mhm.
And so, you get the staking rewards in Ethereum and RPL. And a lot of people struggle to understand, like, why not do this yourself? Why would I want Rocket Pool as some shitcoin token? Part of my language, but it's a meme of the community. And why you'd want it is because it makes staking Ethereum easier, and they've got a good trade-off, because native staking does not offer a liquid staking token, and that's the big unlock. And the unlock idea is that you can more efficiently, use your capital. So not only are you securing Ethereum, but then you're also having a coupon that could be used for other purposes in borrowing and lending. Now, that's not like necessary, but the idea is that that'll probably be a big piece of the future. When most assets are on chain, Ethereum is one of the best assets. And so having that coupon could be beneficial for people. And, DeFi is all about testing out crazy and whatever you can do with online money. And so Rocket Pool is not about testing the craziest things, but it is about helping provide, liquid staking tokens to small investors so they can stake. So I went off the deep end on DeFi, which is fun to test out the weird stuff, but Rocket Pool keeps it simple with validators or with liquid staking.
Yeah, I'm interested to know. You had said last week that the rewards that you can earn can actually be better than in comparison to solo staking. I would like to know more about that and why that's the case.
The case that you would earn more is because you are earning a percentage of staking rewards for the liquid staking participants. So I'm going to share my screen and go into the guide section of Rocket Pool.
Okay.
But the idea is that when you are staking by yourself, you're just earning based on your collateral, your Ethereum that you've locked up.
Okay,
But when
that
you
makes
are
sense.
a node validator, you are also providing that collateral
You're giving
for
that node.
these. Exactly. So
You're loaning your equipment out your node for the validators. So you're getting a portion of their, that makes sense. Okay. I
yeah,
understand.
that's so the rewards come for liquid staking, come on both sides. So liquid staking as well as node operators. You're just talking about when do you make more rewards? Like how do you earn the most Ethereum? And the way to do that is by, running a RocketPool node as a percentage of your staked Ethereum portfolio. So this research takes a lot of people time to come to if they decide that, hey, like I like the idea of staking Ethereum and I need to figure out how to do it, in a way that can't be stopped. And so that would be doing it yourself. And RocketPool is permissionless, meaning anyone can join or exit. And the additional rewards, as you see here, so for RocketPool, if you just put up 8 Ethereum into their validator, which is actually a mini pool. It's in a smart contract with, other Ethereum from the community. You are earning 35.5% of rewards, which is an extra 10.5% over solo staking. So
This
this
is this is a node validator, right? That we're talking
exactly
about.
right.
Okay.
Sorry, exactly right. Node validators. The liquid staking, they earn a variable rate depending on how much Ethereum staking pays out. So Ethereum staking depends on market demand. There's not like a set rate. It's not 5% for life or 2% for life. It's based on the amount of Ethereum that is staked, as well as the network activity. So if there's more demand, like everybody wants to use it, then there's going to be higher rewards for a short period of time. So the liquid staking, I will pause my screen and go over to another site where we can compare, the rewards for.
So you were saying you had mentioned that you said liquid staking. Do you call that liquid staking? Does that count for the bonded ETH and the RPL token or the RETH token? Because the liquid staking is technically the derivative out of it, right? So it would just be like the RPL token, or is it all together combined?
Great
Do you understand what I'm
question.
saying?
They are not combined, but we need to stay specific if we want to talk about node operators or if we're talking about liquid staking. So which one would we like to focus on first?
Let's stick with the node since we started with that. But you
Yeah,
confused. You said liquid. You went back and forth, so I was confused.
my apologies. So the node operators create the liquid staking tokens,
Yes.
and the
Okay.
node operators earn a percentage of the staking rewards. So as a node operator, you are earning, you know, 10 to 15% of the liquid staking investors' rewards. So it's just like providing a service like Coinbase may do for you or your bank may do for you from moving it from your checking to your savings account. In this case, somebody else is putting up more collateral and securing the network, and they are enabling you to get in, and they're charging you 10% for that. So that's why you get a higher ROI, because you're earning a commission from the liquid stakers, so a percentage of their ETH rewards, and you're earning the RPL rewards. So this is the fun part where it's showing you, how much you can earn in rewards, and it varies. And so you can see based on the last 7 days, the liquid staking token, so for the smaller investors, is paying about 3.32% a year in Ethereum.
Mhm.
And the node operators, it's around 8.52%, plus the RPL rewards. And RPL rewards are about 7% right now and will continue to go down as more RPL is staked. But if less RPL is staked, the reward return would go higher. So the tokenomics is a whole nother session, but
Yeah.
you just look at the numbers here, and that is the guiding light. You get more rewards for more risk, Here you get a liquid staking token. It's in your wallet. It is able to be used in other ways, and that is a major benefit. And so that's why there's the good trade-off. So, RocketPool is a trade-off in ensuring that if you're willing to put up more capital and you're willing to run a validator, then you earn higher rewards. Like going back into their documents, if you do the 16 ETH bonded mini pool, which is a validator, you're going to earn an extra 7.5% compared to solo staking. We could have a separate session on like the calculators and how they got here. And people can have different opinions on, what is the net rate of return, because you're also earning RPL tokens, and those then can be denominated in Ethereum or dollars. A lot of people like.
Hey, that was my next question.
Yeah.
How do you convert your profits over from your stakers over to your node operators? So I think you just answered that. So when you have your funds moved over, when you earn those rewards from your stakers, how does that get converted over?
Great question. So rewards are paid out to the validator, the mini pool that is, and I run those. That mini pool operator then distributes the rewards to the liquid staking token holders. You do not know who that is. But there's a large enough group of validators and liquid staking token holders that you do not need to have a one-to-one match and say that, oh, I haven't released my rewards yet. So someone's complaining. They're working to change those dynamics, but how the rewards work today is that node operators and validators release the staking Ethereum rewards to the RETH token holders. And that's just through a smart contract. And you can collect your fees. Now, those are paid out, either, based on every block reward, which could be 10 minutes, or could be paid out monthly if you were in the RocketPool smoothing pool. So the further, like the next layer in the weeds is like, how do you get the most rewards? And you get the most rewards by partnering with other validators who want to stake together. So instead of having an ad hoc, ping and winning a large block reward and getting, it's like winning the lottery. Would you rather win the lottery, or would you just get a guaranteed higher rate of return than the lottery option? And so that is the smoothing pool concept with RocketPool. So instead of getting paid rewards, every 10 minutes potentially, we get paid rewards every month because they are accrued with other node operators. And when we work together, my net return is higher than it would be if I tried to play the lottery and was an independent validator waiting for ad hoc rewards. It gets complicated. Hopefully that wasn't too much, but
Yeah. I mean, that makes complete sense. You combine your nodes, which I think are like your overall supervising machine, and you share your stakers.
Exactly.
And then you have more computing power to be able to earn more of those rewards.
That's exactly right. So that's the smoothing pool as a node operator you could join. Ethereum staking rewards are paid out in every single block. But most validators have a plan for how long they want to stake for. So, I compound my staking rewards. Depending on where you live, you may want to consider, the ramifications on a tax basis. Everybody is a good idea to figure out what works for you. And for me, it's just claiming those rewards when they've hit, a couple $100, and then that's my new cost basis for that Ethereum that I got as staking rewards. I then often, compound that into restaking it, because the idea is that, just let the ball continue to grow as it goes downhill, and then trim it, maybe later in the future when it makes sense. But it's a simple process once you figure out what's right for you, but most people, it's challenging to figure that out. But the node operators that I talk to helped me realize that it's not that hard. And it's like a once a month process to ensure that you are staying up to date. and you're paying out your rewards, or you're compounding your staking rewards. This is not something you have to do every day. It's not like a red alert and rewards are automatically accrued. You just have to claim them and distribute them.
Okay.
Does that make sense? So
Yes,
rewards, yeah, cool.
absolutely. Yeah. Yeah. So you as a node validator choose when to release those rewards, but you're in charge of releasing those rewards and sending them out. Is there a communication between the stakers and the node validators? Is there a way to communicate, or is it just complete smart contract and that's it?
So this complete smart contract is the baseline. So they do not communicate to each other. You can communicate to the team through Discord, but RocketPool is operates autonomously, meaning that the node operators do not need permission to talk to the liquid staking participants or anybody to claim their rewards, to launch a new validator, or to exit their validator. It takes time to do all those actions, but you can't directly communicate with the other side. What you can do is get in touch in Discord with the team, and the goal is that the community communicates through different social channels and or through the updates, but no direct communication.
Okay. And then is one node validator only 32 ETH, or how does that work?
Yeah, we talked in the first video about they thought each validator for Ethereum should require 1,500 Ethereum. Really, it's just 32. That's the magic number. For RocketPool, they've taken that down to 16 or 8. And so, that's a quarter or half of what you need for a full validator. So for RocketPool, it's 8, Ethereum is the magic number. It may be 4 eventually. There are other competitors out there. They're good competitors and some questionable that have taken it down to 4, or even 1 Ethereum to run a validator. There's risk that's not yet known regarding having such a low threshold, like 1 Ethereum to run a validator. Could it be taken over? Could you lose out? And so the research shows thus far that we don't know. And the idea is to start in the safe place with the most amount of collateral, higher bar. And so that's where RocketPool started with 16 Ethereum. And they just moved to 8 Ethereum. So that's really cool that now with just 8 Ethereum, you can have your own validator. Did that answer the question?
Yes, but I was actually thinking on the opposite end. I know the minimum is 32, but you can do more on a node, right? Correct?
You can have multiple validators, correct. So one device can have 100 validators. So the idea is that you can have as many validators as you would like to. It's just like you could have as many shares of Apple stock or Google that you can own yourself. But validators here in Ethereum start off as 32. With RocketPool, it's 8 or 16.
Okay, so you can have up to 100 validators or on one node or one computer.
Yeah, so it's even more than that. I don't know the exact number, but you could have billions of dollars, on one, small hardware device, because that's the power of crypto, that you don't need much to have a wallet address, and to run a validator doesn't take much electricity. It does take a growing amount of storage, but still not too much that it can't be run on a small device at home. And so the max amount of validators that you can run, I'm not aware of. My understanding was it could be like 1,000 validators. So, 32,000 Ethereum can be run with each independent validator. The idea in the future is that liquid staking tokens and validators will have more and more options available depending on your preferences. And we don't see many people on that threshold of having billions of dollars to run that many nodes. But that's how it works today in 32, 18, or 6 Ethereum chunks.
Okay. Now, what about, is there a scenario where you could just supply the node and be a validator and not give collateral to your ETH? I guess not, because you would still have to have collateral. right?
Correct. So, with RocketPool, you do need the RPL token.
Mhm.
So it's not just 8 Ethereum or 16 Ethereum. It's actually, it's 8 Ethereum, and then I believe it's 2 point.
10%.
Yeah, it's 10% for 16 ETH. So when you have 16 Ethereum, you need 1.6 ETH of RPL tokens. And
Mhm.
so the tokenomics get more complicated here. The RPL is denominated in Ethereum. It's not denominated in dollars or euros. That means you need to have enough of these RPL tokens in Ethereum terms, and that's 1.6 or 2.4. And so with 8 ETH, you need 2.4 ETH of RPL. So it's actually 10.4 ETH is the minimum required, right? It's like 17.6. So it's at
Yeah.
16 plus 1.6. And why the difference? It's not a direct comparison, is that they realized they could, adding more collateral could decrease the amount of Ethereum you need bonded. So originally it's 16 Ethereum and only 10% collateral with RPL. So it's the 1.6. But if they ratchet that up a bit more, they were able to take it down to, just 8 ETH and 2.4.
Yes. Okay. So my question is, when you give the rewards or release rewards to your stakers, are those rewards then RETH?
Those, great question. It's just Ethereum. The RETH is the product
Just-
it's earning. It's like the golden
Okay.
goose, and it
Okay, that makes
prints
sense.
out, golden eggs, and that's Ethereum.
Okay, so then that means that your profit then is Ethereum as well.
Yeah, your
Okay.
profit is just Ethereum. It's not, staked Ethereum. You need to take your staking rewards and then convert it into, RETH, or
Mhm.
wait until you've earned enough rewards. It takes many years for the average person to take your staking rewards and then launch another validator. But those people, when you mentioned like 1,000 validators, they earn so many rewards that they could, you know, launch a new one regularly. But for the average person, that's a great goal to get towards, of having a validator, taking your rewards and compounding those ETH rewards from liquid staking.
Mhm.
So the liquid staking token is different than the node operator, and you're just able to trade back your RETH for more Ethereum in the future.
Okay.
And
Okay.
so I can show you, charts that help connect the dots on that. But in essence, your RETH token is earning Ethereum in the background. And so it's worth more than it started off with. And so that means that, when in doubt and you need to go back to Ethereum, or you want to go to dollars, you can trust that, like, it does work. And that is something that I've learned the hard way. And that sometimes you think you got a return when you actually didn't, because the market prices in the
Uh,
risk. So the
okay.
risk in crypto is that you could get rug pulled, or somebody could steal your Ethereum staking rewards. But
Mhm.
since RocketPool is decentralized, there's a lot of trust. And I'll go to a separate reference on that trust. But what we can see here is, this is the staked ETH to ETH ratio over time, and it is only going to go up, because as more Ethereum rewards are earned, this token appreciates in value. You see that our ETH price going up and the ETH price going down because of all the accrued rewards for staking. So this started off back here in November of 2021. So it's actually not too long ago, less than 2 years. That's when our ETH was equal to 1 ETH. And ever since that date, the our ETH token has been appreciating due to the staking rewards that have accrued. So there are 30,000 wallets today. Can't assume those are just individuals, but 30,000 holders. And this is how many liquid staking tokens are on the market today. But a question back for you, a common one I hear from friends, it's like, where should you stake your Ethereum? We're making this for EthereumStakingGuide.com. And this awesome site, which is simplestakers.info, gives you the top competitors in the space. And what we're seeing here, is that Frax, we can go over these in future videos, but you can see that Frax is paying out, the highest APY today, and RocketPool is paying a lower APY. And why is that? That's because Frax has a complicated system and they've added in additional rewards, and or they are taking less rewards for validators as they are compared to giving to the RETH token holders. So there's a trade-off with the staking. It's like, how much do the node operators get for helping create the liquid staking tokens? And most people, want to pay the lowest in fees. So a lot of people choose Lido. This is the #1 market leader, and they're paying 4.43%. If Stakewise is a new competitor, they're paying a higher rate of return, I imagine, to get customers. But when you see this thing and the market price, a negative market price is worrisome. And here you see a positive market delta. And you also see a positive on Coinbase's, but it doesn't look like Coinbase's data is correct here. And what this is saying, the negative 0.07%, is the market is pricing in the risk and not willing to give you the full value that one, staked Frax ETH token is worth. So I've been there before where I had a lot of staked Lido and I needed to convert it back to Ethereum. I got less Ethereum than I expected, which is like, it went down more than 1%. So you'd see a 1.00 here. And that was because there was so much risk around the centralization of Lido, and the market did not want to accept the amount of true rewards that the token had accrued. And that's how market dynamics work. Just because you've earned rewards doesn't mean that others are willing to pay you for it. We can see here, though, that the market globally agrees that RocketPool is worth its native asset value. So
what supplies that, though? I mean, is that still a supply and demand? Meaning if everybody cashes out their RETH, then it would go down in value?
Correct. So, liquidity matters. So that's just the amount of people who are willing to trade on the other side. So if there's mass panic, there's going to be pricing issues for a short period of time. But then the market will come back after the chaos, and you'll see what we have today, which is there's limited chaos in the markets, and we're seeing what we traditionally see with the market price, which means, RocketPool's token is trading at its native asset value. Others are trading below. And I would never trust this. It doesn't look right with Coinbase's product. But, can you ask the question in a different way if I didn't answer it? Or was that helpful to?
Yeah, I'm still trying to figure out what gives RocketPool or the RETH its value as far as how it continues to rise. I guess I'm not understanding that completely. I understand the more the validators, the more demand for the token, right? And the more people that stake, it's going to be more demand for the token. So is that what brings the value up?
So the value that brings up the RETH token is the staking rewards that are made in the background. They are distributed to the token holders, and so that you can go and sell your RETH token for the amount of staked ETH that you have earned during that time. So, the question I think you originally asked was a complicated one. It's like, during market dynamics, can this price be different? And the answer is yes. What the market's willing to pay is always dependent on the market. This isn't the news. This is millions of dollars trading globally. And global investors say today that, yeah, there's less risk in RocketPool than there are these other competitor projects. If we have like massive fear, uncertainty, and doubt, like we have for 10 years of crypto, there could be mass selling. And mass selling could create, price differences in the different tokens that we have within the RocketPool community. But RocketPool, RETH continues to go up just because it is earning staking rewards. Simple as that.
Okay, I have a question before we move on to the actual stakers. Since you are a node validator, can you think back maybe what was your kind of number one error that you learned from, or something that you wish you would have known before you became a node validator? That would be helpful to know.
Yeah, great question. Another one. If I were to do this over again, I would, uh, you know, get the test nets set up ahead of time based on my delivery dates I had planned for myself. Um, testing and doing more testing is the best way to have confidence. You can't just, assume that by buying a DApp node and plugging it in, that it's going to be all up and running perfectly. So for me, I'm still working on getting, what I would like to be the ideal node infrastructure set up with the correct backup power and the rescue node set up correctly. And so I'm working on testing that now. And if I would have done it over again, I would have planned to set that testing up earlier in the process so that I could feel like complete versus, I'm more of a continuous testing phase here. And I also rely on, a third party service provider to host some nodes for me. And so, that doing it over again, I would have just done a bit more testing so I could be doing more in-house now than I am today.
How would you go about doing more testing?
Doing more testing would just involve setting up the RocketPool, stack on testnet. So that's Go Real is the
Yeah, I
best
saw that.
test. Yeah, and so that takes getting some testnet tokens, and that is, those are free, but it does take getting help from the community to get those. So you either need to, reach out in Discord or
I saw that.
to,
Post
yeah,
something on Twitter or something, and then you get so many tokens, but you only get 32. So if you mess up, you got to do it over again.
yeah, the Twitter request is quite common because there is something called like a Siebel attack, and that's just when there's an automated request that keeps saying, "Give me more tokens, give me more tokens." So to stop that, they make sure that you're a real person you can validate in some way. So you can delete those tweets after you send them, but it's very common to get testnet tokens that you have to say like, "Hey, I am this address and I am requesting tokens," and then they go check an API and be, "Yeah, your Twitter profile has been around for a long enough time period to be a real human. We can give you some of those tokens. It just takes more time." And so I hope to help you to, feel good about this timeline to get up and going. It doesn't take as much time in the weeds of setting it up as it used to, but, realistically, it takes, 3, 5, 10, 1 hour sessions where we just go through the plan. You play with the validator yourself, meaning it's set up on testnet. And then, we begin doing the production launch. So it's copying everything you did in testing, and you don't feel as stressed about the slashing risk or other things like that. Like, it's going to happen. And so you've already set up the rescue node and the backup procedures that, like, hey, I didn't lose my funds. This is not an FTX scenario. It's just like I'm not earning rewards right now while I'm not online. And so, like, get my validator back online. I'm earning rewards again, like back to relaxing.
Okay. Yeah. And it sounds like even with the test net, that takes time, because once you even get the Ethereum, you have to give a couple days for it to even go through. And then it takes a lot of time. It sounds like takes a lot of time.
Yeah, it's a process, and the trade-off of being permissionless is the time. So if you're allowing anyone to join and to lock up their money and join the network, like, there's risk when you allow them to do it quickly. So RocketPool has added additional time required than the Ethereum, around 27 days to unlock a validator. So with RocketPool, it is like 28 days. And there's pre-steps you need to do to get going. So it's realistically, about 30 to 35 days of actual time once you have your tokens in your wallet to get your validator, launched. And that's just because it's permissionless. So you're joining others, you're waiting in a queue. And once that queue has filled up with enough participants, then it's sent to the beacon chain. Those validators are launched and you're up and live. It's not,
So you don't really you couldn't pick that you want to be with this certain validator node so it's just randomly chosen.
correct. So newer projects are enabling that, but
Mhm.
RocketPool has normalized it, meaning that it's random.
That
Maybe
that
not
almost makes a lot of
normalized, randomized.
Yeah, but that almost makes a lot of sense as well. To make it random.
Yeah, I think random matters, but then there may be some, there could be reasons why you would like to see all the data for who you're staking with and ensuring that they are a good validator. That's the thing about RocketPool, is that if some of the node validators, get offline, then, our ETH holders are missing out. And so newer projects, like BlockSwap, is figuring out how you can track the validator's performance, and you can switch validators. So if you as a liquid staking token holder don't want to be held hostage by your node operator, you may choose a different network to stake on. And so RocketPool is the second largest today, and it has market trust. And so that's a great place to start. But diversification, like we talked about, is the name of the game. And so diversification in your staked Ethereum or your node operators is also the strategy that I suggest. So we're starting here with RocketPool, but I'm excited to test out other stuff with you so you can have a diversified Ethereum staking strategy.
Okay. Do you want to move on to then the staker portion or the liquid portion as far as how that works? You kind of explained, because the node validator is the one that's really giving out those rewards, and that the stakers have a more customized or less customized APR than the node validators. Like they get the 3.32% on average, and then the ETH as far as return, right? And then,
so yes, they get paid in ETH. They're getting 3.32% a year in ETH. That could change based on market dynamics, and that's not much. But when it compounds, and Ethereum is, continuing to grow and is valued differently than the current market price, that's when things get really interesting.
Right.
So
is there a chart that someone has? It has to be almost like a calculation or an estimate on what they think, in 5 years, what, or even 2 years, what the amount of validators there will be on the network and the percentage of that. And then also the accruing value of Ethereum. Is there some kind of chart or anything that anyone has made to be able to kind of at least predict and look and say, well, this is probably what it may look like in 1 year, 2 year, 3 year?
Definitely. There are lots of things out there. One of my favorite resources is stakingrewards.com. I will pull up my screen and go there. It's not perfect in the fact that, they don't necessarily consider the MEV, which is the additional rewards paid for high demand. It's like if you want to be in the Super Bowl commercial, you got to pay a lot. So if you want to use Ethereum when there's a lot of demand, the additional payment is going to go to validators. And so I want to get back to what I was sharing here on the staking rewards as a resource and how much you can pay. And to highlight back to what we've been talking to is that we're talking about staking pools, and this is not, a validator as a service, meaning you're paying someone else to run your node when you have 32 Ethereum. We are not also talking about running a validator yourself, where you have the 32 Ethereum and the hardware, or the horrible option of doing it through a centralized exchange when they have your private keys and you don't really own your assets.
So then it seems like that percentage it's saying that the solo staking, you're actually making more of a percent, but really, like you were saying, that if you do the pool as a node validator, then you actually earn more than the solo staking.
That's exactly right. And so stakingrewards.com summarize the rewards that you would get, and they did not consider putting in RocketPool as a option there, because RocketPool, like most staking pool solutions, there's the validator side, which we've been talking about, and those are the ones that own more rewards. They just had the option, we'll bring it up again before we go into the chart, is just the liquid staking option. Presented here, we did not have the run a RocketPool validator, which would be below this and would be even higher returns. So yeah, this is something I can leave you with, but this is a complicated guide that I put together and trying to simplify why RocketPool. And so I'll leave you with this, and hopefully we can cover it, next time. But this is a deep dive into the staking rewards that you earn with RocketPool, and then how do the tokenomics work? So you're like, depending on how much Ethereum is staked, how many validators will we have? And there is some really good math.
This is what I was wanting, like depending on, because I need to be able to understand the tokenomics so I can understand where the interest comes from and how you earn those rewards. I think
the more that's staked, the lower the reward. So the earlier you get in, the better.
Yeah, that makes sense.
The more that is staked, the less reward there is, but here's the issuance rate of return. And at one time it was 13%, but it's going to go all the way down to 1.5% if potentially almost all the Ethereum is locked.
But wouldn't that raise the value then potentially of Ethereum? That would raise the value of the RETH.
So the staking rewards will raise the value of RETH. Once again, RETH continues to go up in Ethereum terms because it is accruing the staking rewards, that passive income, but that amount of rewards goes down as more Ethereum is staked. So right now we're earning the highest rate of return we can, just because there is, the least amount of RocketPool and Ethereum staked. So that chart I made highlighted how Ethereum, or above here, and these tokenomics are potentially going to change. And so that's actually really good news.
Yeah.
And the good news is it's going to lean towards favoring smaller investors and the RETH token holders. Back to it, you have a trade-off between the validators and node operators and the small token holders. And like right now it's favored towards node operators because they're taking more risk. But as there are enough node operators, and the liquid staking token holders, have a bigger voice, we're going to figure out how to make sure that the really wealthy can share more with the smaller investors. That's talk that's just come up in the RocketPool community in the last 2 days. And, it's quite, like, we call it gigabrain stuff, but it's fun to look into and to understand that, this is just a business that is changing the dynamics of its equity to optimize for participation.
Yeah, and that makes sense because that seems to be the overall goal of RocketPool, is to make it decentralized and to make everyone to have skin in the game, and not have Kraken and Coinbase own the majority of the staking.
That's exactly right. That's, most people don't want to take the risk, but it's becoming easier. And the key we didn't talk about is also self-custody. That's what you just mentioned there. Like you could have self-custody and not choose, Coinbase or Kraken, but then you could also choose Lido, and they are centralized. They have, very few validators, and you have to trust in a small group that they're not going to, do anything of malice. That's counterparty risk. And so they take less staking rewards. But from my experience, I lost out because the market priced in the risk accordingly due to their centralization. And so the market prices in RocketPool's risk at very low. So the staking rewards are, valued in real time and not discounted based on the centralization fears. So it's like that extra layer, and you're right, it's not Coinbase or Kraken, and it's also not Lido, or a centralized staking provider who could have counterparty risk.
So Lido, I know they didn't have a lot of node validators in comparison to RocketPool, but do they also, I guess, vet their validators? Like they only are able to have a certain amount of validators and they vet every single one of them? Is that correct?
Exactly. It's permissioned and it's whitelisted. So think of it as like, hey, let me just pick who we want to allow into the community. And there's trade-offs there. It's like, I'd like to use centralized services for some things. And then in other things, I want to have full control. And what I've learned is that, full control is the way to go with being a validator, or at least with crypto, because there's just too many risks with trusting someone else when all of this stuff was invented to be very easy to do peer-to-peer. It's just that we haven't created the guardrails for the average person to understand this yet. And there's so much confusion, but like, the average person will just simply be able to take their dollars and put it into liquid staked ETH via RETH and forget about it. Set that up monthly, daily, yearly. And those others who do research and want to participate more actively will be node validators, and we'll get the chance to also then do other cool stuff. So I love that you want to take the active participation, and we're hoping to find others. So what's like the big thing you took away from this session, number 2?
So I think the main thing is I'm getting comfortable of kind of the dynamics of the node validators and how they are able to oversee the stakers, and then they're able to give out the rewards. Basically the premises of the RPL rewards and then also the RETH reward. That was separated last time, and then going into how it's a trade over of it's given out in ETH rewards.
Yes,
so
exactly.
The more nodes that you have, the higher the risk, but also the higher rewards or revenue you're going to bring in. So it's like that compounding interest. If you have those nodes, or if you start out as a staker, then you continue to build that interest, and eventually that compounding interest, you could eventually in the future, if you wanted to be a node validator, learn the hardware and the equipment, you could do that. So it seems like it can almost be a stepping stone from starting out as a staker and then earning those rewards, and then kind of figuring out the network, and then just using that compounding interest of maybe staking more or adding on. I didn't realize also that you didn't get to pick your node validators that were chosen for you, and then you don't also or decide who you're staking with, whatever you decide to do, the 8 ETH or the 16. So I was not aware of that. which makes sense to me because I mean, it does make it more decentralized. And then it also makes it easier when it's in a smart contract. What else? Anything else?
You're a great listener. You ask lots of good questions. I often think I'm just, talking to myself in the corner or excited to share. But I'm grateful that you paid attention. I like the stepping stones analogy. And I agree that's the goal, to become a validator. And the bar will be decreased in the future. Some are testing out 1 ETH validators today. That is not safe. 8 ETH validators is safest. 4 is others are doing. And when you talk about not being able to pick your validator, there are others who are enabling you to pick your validator. Maybe RocketPool will update to include such ability, but it is normalized today. And yeah, the business aspect of it, I don't feel like I gave you a good, summary, but that's where each individual needs to do their own, analysis and kind of take into consideration like estimates on the price of Ethereum and then estimates on the price of the RPL token, and why they'd want to stake and take more risk now as a validator than maybe participating later. And a piece that you to help clarify, validators take on more risk by running more validators, but they have limited risk because you just have to keep that one node online. It's not like you'd have 32 individual units or 1,000 data storage units around the world. So that risk is somewhat limited to the upside once you have enough and you can scale. But realistically, most of us are just looking to liquid stake or figure out how over time we can get to a validator. So paying out rewards in Ethereum is the name of the game. And so that is the liquid stakers, Ethereum rewards, and the node operators are earning, not our ETH, they're earning ETH as well. And then RPL. So node operators earn 2 types of rewards and more rewards for the risk they take on.
Yeah.
Thank you for going over today
and then
too.
One advice you gave was more testnet.
Yes, exactly. It's like more testing. So don't make sure you feel good before you move on instead of just following somebody else. To me, it's a combination of just taking action and testing, but making sure I test twice or 3 times if it is in production. It gets easier, trust me.
Okay. All right.
Thanks so much. What a great summary for round number 2. I think we can, try to make this a 3 to 4 part series. It's really up to you. And I know each person is different, but for sure in 5 parts, we're going to make sure we can show on your phone that you have some staked ETH and or have a good plan to get towards being a validator. Does that sound good? Awesome. All right, I will, yeah, thanks so much.